So I am the Chief Investment Officer here at LAGERS. Oh, I'm supposed to say Happy Halloween to everybody. That's a shout out to Tammy. I tried to get her to use the word Halloween in her presentation yesterday and she couldn't do it. So I just did it. I got it accomplished. Chief Investment Officer, my job is to help you have a secure retirement by making sure the funding is there. That is my role. So I work for all of you guys. And so if you have a question about anything investment oriented, that's my expertise. If you have other questions, I'll send you on somebody else, but investments, ask me about your personal, loggers, anything. I work for you. There's no other way to put it. So we're gonna go through here. I'm gonna quickly go over some numbers, not too much. And I'm gonna end with one of the questions I think Jeff gets a lot out in the field is, how can I make my money, my DC, my 401k, or whatever you call it, more like loggers? So I'm going to try to help you do that in a way you can do that. So I'm going to end with that. I'm more of a teacher, so I want interaction with the group. I don't want a painting, so stop me, ask me anything. I will try my best to answer it. I'll hopefully repeat it so everybody else hears it also. That will be the goal. Are we all ready? All right, let's go. So, I got to point this back there to get it to work. Maybe. Oh, there we go. So this slide is, if you've been here before, you've probably seen it before. This is I had Jeff draw this 10 years ago, and he probably doesn't like the fact I'm still using it, but I am. This is what we do, right? So I do this part. I'm a little surprised I'm off the screen. I do this part, and my goal is to make 7.25. We've talked about that. The employees are putting in 4% if required. And that's going in here. And the employers are putting in 11.2 right now on average, and that's going in. I used a ladle for myself because some years I put money in and some years I splash out. And that's the nature of investments. Last year we did 19. This year we didn't do 19. We did 2. But over the last 5 years, we've averaged way over what we expected. And that's why we smooth. That 5-year smoothing that was mentioned, we knew that was going to happen. It wasn't a surprise that some years are up or some were lower. So we smooth those earnings in over 5 years. So that means whatever we made last year, that 19, we only took 1/5 of that and recognized it. The other 4/5 we set out for the next 4 years to bring in because we know it's going to be volatile. That term volatility, ups and downs. And we'll talk about that later on. I put some numbers up here I thought it was interesting as a numbers person. 67% historically over the last 20 years came in from investments, 3% from employees, 30% from employers over the last. So I put some numbers around that just to give you a feel. So this is the dollar amounts of those. So 219 million came in from investment returns, 9 from employees, and 98 from employers. So that just gives you some numbers and give a feel for how big or small it is. It helps me. I don't know if it helps you. Get your feel around it. So as Keith said, we're 94% funded. So that money, 68% of the last 20 years has been saved for future retirees. And the other 32 has been given out for the people who are collecting the money and growing. I had breakfast with someone who said he's retiring in the next 6 months. And he's moving down here to the receiving end of that, right? That's a wonderful place to be. Yeah, I am not quite there yet, but I definitely understand that's a joyful way to be receiving as opposed to saving. Any questions on this? Everybody kind of get it? That's what we do here. Go ahead.
You said that the employers average contributing 11.2%.
Yes, of payroll.
And employees 4%. So that's an average of 15.2%.
So no, let's be clear. So if you pay in, you have to pay in 4, but not everybody pays in. Okay? Right. So that's why that 3, I'm gonna look for somebody else to be able to know how much on total contributions. The employers are paying in 11.2. Is it like 11.8, 11.9? I'm looking at Jeff or Bob. You'll know off the top of your head. It's not 4. It's a lot smaller because not everybody pays in. I can get that number to you. I just don't know off the top of my head.
Well, then what would the average be if you combined employees?
That's what I was looking for. So you want what everybody's putting in, employer and employer together. And I think it's slightly under 12. Is it 12? 12-ish. I don't want to give you a number and it'd be that wrong, so I'm saying 12-ish like that. That way we're close. Does that make sense?
Yes.
All right, any other questions before I move on? All right, great, I got interaction. That's wonderful. I get a gold star. If I can get this thing to work, I'm gonna, it's like a delay. All right. So they're the stats for the plan currently, as we said, as of June. We're different now, but as of June. So we were up from last year. That's a good thing to be. I'm gonna stay over here because I'm closer to the computer. We're up from last year. Our funding ratio was up. That's another great thing to be. Average employer contribution, same number, went down. So those returns has helped lower the employer contribution. It didn't move the employee contribution because it's static at 4 if you're having to pay. So the employer contribution will move it up and down based on how well we're funded and other factors, but it went down. So that's pressure down is good. We did not change the assumed rate of return from last year, so it's the same. We feel that's a comfortable number. Yesterday we had a board meeting and we went over asset liability, revisit that, and we still think it's a comfortable number. I don't think I'm gonna come here next year and tell you it's changed. We're comfortable hitting the 7.25, and that is not yearly, and that's why we do the smoothing. It's over a long period of time. Our goal is to hit 7.25, right? So what has changed in the portfolio from last year? And we will get into this a little bit later, but equities have gone down. I don't want to say I'm worried about inflation, but I look at the portfolio. If inflation happens, we will be hurt by that. And I don't want to be hurt by anything. I want to prepare for any weather that's coming. And I don't know what the weather is going to be, but I want to prepare for it. So having more things that are inflation oriented is something we're trying to put in the portfolio. Equities get hurt with inflation, so we're trying to lower that allocation to equities a little bit. So where is it going? It's going to fixed income a little bit. And more importantly, the real assets really move up with inflation. So think about inflation, your house value goes up, cost of gas goes up, everything goes up. And those things move up, real assets move up with inflation. So we're trying to get more exposure. In the short term, that's hurt us. Gas prices have fell, inflation has fallen in the last year or so. So that has hurt us, but in the long term, it will be better off. It will be a smoother ride if we have more exposure to that type of investing. Our strategic allocation has also gone up. These are opportunities we're trying to find in the marketplace, take advantage of, and one of those is oil. We're saying oil is being so low right now. I don't think it's going to be low forever. So we're trying to buy some more oil in this opportunity because it's a low price, buy low, sell high kind of concept. So those are things that we're trying to do in that portfolio, and we've increased that allocation to strategic. These are our number of managers have gone up, and our number of mandates with those managers have gone up. The more things we move into, we have to get more outside people to help us. The managers, when I say a manager, this is a portfolio, equivalent to a mutual fund. We call them portfolio managers for us. We hire them to do run certain types of money for us. They run equities or they run fixed income and so forth. So we have 50 different managers in the portfolio, and they're doing 70 different mandates. Some of them do more than one thing for us. We try our best to utilize them to the nth degree. We view them as they're on our payroll, so we want as much work out as you can possibly get. That is very important to us. And we pay them all on, and we'll touch on this in a second. We have, just get the next thing down. We have about 30 opportunities that we're doing directly ourselves. Opportunities come to us that not through a manager, through other ways, that we evaluate and say, hey, we want to do this directly ourselves, not through a manager. And we've got about 30 of those going on. They tend to be loans. We'll through our kind of our connections, we'll find out a company needs to borrow money, and we'll get involved in that, analyze if it's a good credit or not a good credit, and we'll make that loan to that company and so forth. So the most of those 30 are those loans that we make. Few equities, but mostly debt. You'll notice our fees here are you might say high. I mean, last year someone said, why are your fees so high? And I thought of a good way to think about this. We have part of our portfolio is in similar mutual funds that you guys can invest in, and those fees are very low because we can negotiate very low fees on those. The others are other parts of our portfolio in the private investments that most people don't invest into. Here's my analogy for the day, and our media guy said try to use analogies. I always view as investing in public equities is similar to hiring a real estate broker or real estate, not broker, but a agent to help you find a house. You pay them not very much at all to help you find a house. And that's equivalent to buying equities. The equity already existed, the house already existed. This person is just helping you find it, so it's a low fee. But if you hire someone to build you a house, you pay them much more than you would an agent. And so that private equity that we invest in, is they're building companies for us. And we're prospering on those companies being built. So we pay them a lot more to build those companies, and we expect to make a lot more when we build those companies. So we pay them more and expect to earn a lot more. So these fees might seem high if you compare it to mutual fund fees, but a good third of our portfolio is invested in private companies. We're having people build companies for us and make money off those. Example of one of those companies is, I don't know, we ate lunch there on the way, Noodles and Company. One of our managers built that company, built that restaurant, brought it up, and then sold it on the marketplace, and we made a lot of money on that process. So we paid them to do that, but we're all about paying you if you make us money. I'm a big believer in, if you make us money, we'll pay you. I'm a big fan of that. So hopefully, any questions more on this slide before I move on? There's my analogy. Was that reasonable? Okay. My wife hates my analogies, but she hears them all the time. That's different. All right, any questions? All right. So this is what we've done for the year. This is my eye test, hopefully the only eye test in the slides. We'll find out. For the 1 year, we were under our assumed rate of return. But remember, we're not shocked by that. It will go up and down. That volatility will happen. So the 5 year is more important to you guys, because that's why we smooth in over 5 years. So 5 years, we're over our assumed rate of return by a lot. That's been why the pressure down on rates and so forth. That's why our funding ratios went up. All that's more based on the 5 year number than it is on the 1. I can't have 5 bad ones. I know that. I realize that. I can't let that happen. But 1 being a bad year, 1 year doesn't bother me too much. Last year we crushed the ball out of the park, so you're not going to have a bunch of really good years in a row. It's going to happen this way. So look even longer term, just to get a feel. 10 years has been kind of right on it, not much different, which is okay, not great. 20, even better. 30. And I would say the 20 and 30, I looked at Ashcroft. He's been around here this long, so he takes a lot of credit for those. And then the since inception, we've made that. So I'm a little bit of a visual person, so how's that look dollar-wise? So the next slide kind of shows you, if we would have just made our assumed rate of return, then the money we got in from the employers, no more, no less, we would be setting at $3.1 billion. If we just made our benchmark return, so if you've noticed in the previous slide, there's a benchmark up here at the top. If we would have just made these custom index returns, we would have been the red. Oop, I went the wrong way. Oh, I'm going the wrong way a lot. Let's go back. You got previewed. I'm really going the wrong way. I'm looking back to Jeff. Stop clicking? All right. I stopped clicking. I'm not clicking anymore. Are you doing it? I'm not clicking. Ah, there we go. Click forward. There we go. So we would be setting at 4.4. We're not setting at 4.4. We're setting at 635. So that's about those returns, those excess returns, and making those returns gives you a visual feel for how much more money we have in the plan because of those excess returns over the assumed and over our benchmark. All right, any questions on that? I'm going to stop using this device. All right, so how do we do this, right? A lot of people ask, how do we accomplish this? And I'm going to try. So over the 10 year, we've been 7.7. So what has gone into that 7.7? Well, the equity market has surprisingly been not great over the last 10 years. It's kind of lower than we all would have expected. 7.1's not where, we're kind of projecting 8-ish, 8 or 9 for the equity market, right? It's kind of a little under our expectations, not a lot, but a little. The one that's really over a lot is the next slide. The next one is fixed income. We did 7.8 for the last 10 years in fixed income. Nobody would have expected that. And I sure don't expect it for the next 10 years. How low can rates go? 0 is kind of as low as they can go, right? So it can't keep going down. So remember, rates go down, the price of fixed income goes up. But you kind of have this natural bottom at 0, so then there's a price that can't go any higher. So I would not expect another 7.8 for the next 10 years in fixed income, just because Negative rates, I'm not sure how that works, right? It might work, but I'm not sure how it works. So real assets, and this is really due to recent activity, has had underperformed for the last 10 years. This is driven by oil, right? That is the biggest real asset that we use, and real estate, but oil and real estate are the two biggest. Underperformed. I view that as a good opportunity to buy low, sell high, and we're trying to take advantage of that. Our strategics have done well. Those investments, we've had people building us companies, those have done well. They've done higher than equities, higher than everything else, and that's what we expect, right? So how do we do it as staff? We fully utilize our managers. And when I say that, I think it easily goes by. We make them do everything we can think of for them, to the point where they're almost to the point of, really? You're making us do that? Well, and I always want to say, want me to show you how much I paid you last year? Yes, I'm making you do that, because why should I hire or pay for data or whatever when you're already paying for it with my money? I'll get it from you. So we utilize them for as much as we possibly can, up until they're screaming, right? A little under the screaming, but close as we can get. And I think everybody, you guys are in government just like I am. Utilize your vendors as much as you can, up to the edge, right? As long as they're not firing you, I think it's, that's where the line is in my eyes. When they want to not take my business, I need to go a little underneath that. We're a small investment team, and I think that is really, really helpful. We work as a team. One of my team members is due any day now, so that's why she's not here. So our team is going to expand shortly. She claims she will be working next week, which is crazy in my eyes. She's literally due on Monday, but we'll see. We had a staff meeting Wednesday, and she usually takes the notes and so forth in our staff meeting. And I looked around, I go, hey, who's going to do this next time? We have to do it every 2 weeks. She goes, well, I'll do it next time. I'm like, okay, the best case scenario, your child's going to be 2 weeks old, and the worst case scenario, your child's going to be a week old. You're not going to be taking notes in this meeting in 2 weeks. And she's that dedicated, and she wants to be involved. She goes, well, at least call me so I can listen into the staff meeting and keep up to date. I'm like, all right, we will call you if you want to, right? Those kind of things. That's how dedicated she is. And we cover everything. We both focus on the total portfolio. So if someone calls us and if they want to talk about something, if they get her, great. She can take the call and answer any questions and so forth. Or if I get the call, I can take the questions. And there's the two of us on the investment side, and we have two other folks on the operation side. And they handle the operations and keep us up to date. Authority to make decisions, and this is also huge. Someone can call us, and Megan and I, the investment department, can make the call, yes or no, we want to do it or not. We don't have to tell them, hey, we have to wait till a board meeting a month, or we wouldn't get a lot of those 30 deals I talk about. We wouldn't get them, because they're like, hey, we don't have that kind of time. Steel's closing in 2 weeks. We need a quick decision so we can execute. So the way it works is we have the investment decision as long as we stay within our asset allocation, and we report to the board the following board meeting, all those investments that we've made between there. So we have guardrails, for lack of a better way to put it, around allocation. So we can make anything within those guardrails or push down a staff decision making. We can't go outside those guardrails without going to the board, but within those guardrails, we can make the calls. And that gets us so many more deals than you might realize, because so many people take 6 months for a committee to make a decision, and the deal is come and gone by then. We can make a decision fairly quickly. We analyze it ourselves and execute. And we really think about risk. I think that whole real asset category came out of our risk analysis of the portfolio. We looked at the portfolio and said, hey, what if we have a high inflationary time, low inflationary time? What are we going to do? And what's the portfolio going to do? And we were worried about high inflation, so we're trying to get the portfolio to be, I don't want to say balanced between those two, but at least less skewed toward low inflation, doing well, and doing poorly in high inflation. Any other questions on this slide? Anything? I had one so far. Come on. All right. So now I'm going to go into something I think might be more interesting to you guys on a personal level. As I said, Jeff gets this question a lot. I'm going to try to help you guys build this portfolio as close as you can get the LAGERS portfolio in your own DC environment. I would say there's a caveat to this. Remember, LAGERS portfolio, I always imagine it as around a 50, 55-year-old person, not quite in retirement, but closer to retirement than, so if you're younger than that, maybe you can have more equities and less of the other things. And if you're a little older than that, maybe more fixed income and less of the other things. But slightly moving that around, keep that in mind when we go through this. So younger, slightly more equities, and I say slightly, maybe 5% more, maybe 10 at the most. And if you're older, maybe more fixed income, 5 or 10% more of that. Okay, is everybody, that makes sense to everybody? Trying to move in that risk curve a little bit. So I keep pointing it that way. All right, so passively. I'm a big believer in passive investments for individuals because we can't negotiate fees as I can as a CIO of LAGERS. I've got $6 billion. I can demand lower fees because I'm giving them a lot of money. My personal portfolio, I can't do that. So passive is a much cheaper way to get it accomplished. And the biggest risk you make is asset allocation, not the manager being an outperformer, so forth. So just take that off the table, go passive. My investments are all in passive in my personal portfolio. So that means index oriented, the low fee index, Vanguard. I always feel like I'm doing a Vanguard commercial when I do this, but that's who I use. They are the Walmart of mutual funds. Very low fees, okay? So all these are in passive oriented. So 50%, I got kind of cute with the slides. So let me know if you like this or not. 50% into stocks. S&P 500 is the index that most people think about. So 50% in stocks. All right, does everybody understand what I mean by that? Yes? Painting? All right, great. And 25% in bonds. I put U.S. aggregate bonds. Your 401k provider might just say diversified bonds or something like that. You want 50% of it in bonds and 25% in bonds. All right? Is everybody with me there? Everybody get what I mean by that? Those are usually pretty easily found in every 401k out there, provider. The next one's going to be a little harder, but I think this one takes a little bit more work, is getting 25% in real assets. And I say real estate and commodities. Real estate's usually able to accomplish fairly easily. Most 401ks have a real estate allocation in there. The commodity thing, you might have to try a little harder. There's plenty of commodity providers out there. Fidelity has a commodity index that people sell. I know that. I think Invesco does. PIMCO does. So you can find them, but there's probably thousands of stocks that are index oriented. There's probably thousands of bonds. There's probably hundreds of real estate and probably dozens of commodities. So it's a little harder to find the commodity one. But you want to get commodity exposure because that's all about diversifying during inflationary times, getting that exposure to commodities. All right, I'm pointing back at her. Try it again. I hit it twice. There we go. So regular contributions into this. So don't just put in there like a big chunk at once. You want to do monthly in. And that way, that naturally allows you to buy low and sell high, right? And the sell high part will happen in the rebalancing. So when you rebalance back, you will sell high, and when you're regularly contributing in, you'll be buying low, right? That's the beauty of the rebalancing. And this will probably surprise you guys. I only rebalance my personal portfolio, only once a year. Because I focus on investments all day long, every day. On a personal standpoint, I just visit mine once a year, and it's fine. If you're more into it, do it quarterly. But if you're not, and I run about a dozen of my personal friends' portfolio, and I rebalance theirs annually just with mine. Because you'll be surprised at how little it really moves, when you only rebalance annually. It doesn't move, especially if you're making regular contributions at the same allocation. Because they're going in at their target allocation, so whatever it's moved, it doesn't move much. So visit it once a year, ignore it. The other 3 statements you get, file them away, don't worry about them. You get to the December statement, rebalance it back to this mix. All right? So why this portfolio? So, that's what everybody wants to know is why this portfolio as opposed to some other portfolio. So we're going to talk a little bit about risk and standard deviation that Keith mentioned. This is equities over the last 20 years, right? So this is a great return. But the problem is you got to be willing to withstand these bottoms. This is negative 20 in a year. This is negative almost 30 in a year. So that's the evil you're trying to try to get out of your portfolio. If I could take this without the ups and the downs, that's fantastic. So everything else is trying to lower this risk. The 17 is the measure of risk. That's just, remember, the 17 is, and we're trying to lower that. Our portfolio, LAGERS portfolio, has a target risk of 10. So that's our target risk is 10. Okay? So everything else we add is trying to lower this risk factor. So this is a 20-year equity returns. Okay? So what are you going to add? First we're going to add bonds to that. Well, here's the bond chart for the last 20 years. I kept the scale exactly the same. So here's a good, always look for someone changing the scale on you to lie to you, right? Because that is the easiest way to lie in graphs, is change the scale. I did not change the scale on any of these graphs because I find it as a pet peeve. When someone changes the scale, I immediately stop listening to them because if they're willing to lie about that, they'll lie about a lot of things. So I stopped listening at that point. So the scale stays the same. You'll notice just visually it looks less volatile. There's not nearly as much ups and downs. Well, the number is 4, just to get a number around it. But the return isn't something you probably want over the next, right? But you add some of this to dampen the volatility, to lower that volatility. Does that make sense why you would add bonds? Is everybody there? Any other questions on that? All right, so the next one is I combine 50% real estate, 50% commodities. So here's the graph on 50% real estate, 50% commodity. And you'll notice there's some big ups and downs here too. This is the real estate / commodity bubble, the Great Recession. Right? So this is a lot up and down. Also actually has more risk than equities and less return. So your gut reaction is, well, why would I do that? If it has more risk and less returns, stick with equities. But the difference is, and I'm about to show you in the next slide, is those returns act very differently. So you'll notice here that I try to go again. Oh, Jeff, can you hit 1 forward? There we go. So one's going up while the other one's going down. So it's called uncorrelated is the fancy term, but one yang and while the other one yang. So my professors in school would use you should sell umbrellas and suntan lotion at the beach. Because some days you want to sell suntan lotion because it's sunny, and the other days you want to sell umbrellas because it's raining, right? So you would make more money if you sold both than if you just sold one. So we would invest in commodities because its correlation, that's the term for it, is negative towards equities. So that's why we're adding that. It lowers your risk even more than you would think because the correlation works in the opposite direction. And you'll notice virtually most of the time when one has a big down, the other one's up high. The only time in experience, and I colored it red because both of them got hurt during the Great Recession. It's not perfect. It's not perfectly negatively correlated, but it is negatively correlated. So the Great Recession hurt them both. So that's why you would add real assets to the mix. So when we add those 3 components, equities, bonds, and commodities or real assets, this is what the chart looks like with those together. So our return, 7.9. The risk is slightly more than LAGERS, 11. Okay? I'll give you a feel for what LAGERS is. Here's LAGERS 20-year number. So we did a little better return, 8.7, a little less risk, but pretty close than just doing this passively. You could do this very easily yourselves. We spend a lot of money doing this because we have a lot more money to worry about, right? For us, you're like, oh, we're making less than 1% more. We're only making, I'm going to use one of those terms, 80 basis points, which I was supposed to, 0.8%, how about that? 0.8% more, but it's on $6 billion, so that easily pays for our staff to do this and so on and so forth. If you got $6 billion, you should probably pay for staff and so forth to do that. And if you don't, then it's probably not worth it, right? It's probably not worth it. So you don't get quite as much return, and you get a tiny bit more risk, not a lot, and that's how close you get. All right, does that make sense? That is my, how to build this at home.